So, in this section, we're going to be talking about working capital. And what is working capital? Working capital is the sum of an organization's investment in current assets, basically, our total current assets. Working capital is the amount of cash that basically, or liquid, fairly liquid assets that we have to work with as an organization. So when we talk about current assets, these are things that can be converted quickly to cash within a year. It's how can we make our payroll? How can we pay for those items that we need to purchase to keep our business running? That goes into the liquidity of our organization, which is basically what we're getting to with working capital. Current assets, when we talk specifically about current assets, we're talking on the balance sheet. You'll see a section and it will say current assets section, and that is within a year. Assets that can be liquidated within that year. It'd be cash, short-term securities, accounts receivable, inventories, and prepaid expenses. So accounts receivable, we're going to be talking a lot about that because when we talk about the revenue cycle and managing that revenue cycle, our accounts receivable is a big piece of that. Inventories, for supplies, we might have somewhat medical inventory, and so managing that as well, and having prepaid some expenses. And other than that, just our cash and short-term items. Our net working capital is basically if we take our current assets minus our current liabilities from the balance sheet. So we go to the balance sheet, there is a current asset section, and then there's the long-term assets, which would be more like your property and buildings and equipment. And then there is liability section. So there's current liabilities that are within the year we need to pay. And then there are the longer term. So longer term would be debt and things like that. Current liabilities are things like wages payable, accounts payable. Those are the things that we owe, that we need to pay. So when we look at sources and spending of funds, we can look at kind of a cycle of that. And here is a cycle from day 1 to day 63 from your book, and looking at both sides of the equation. The first thing is current assets, being our accounts receivable, being the big part of that. And then on the expense side, looking at wages are going to be our most substantial, as well as regular vendor accounts payable. So when we look at accounts receivable, we're going to see the client, we're going to see that patient, and then we're going to possibly have some pre-authorization from insurance for that. And eventually what we're going to do is we're going to bill that insurance. Here on day 3, we bill the insurance for it. And then once we submit it into the insurance turns around and pays us. So we might get paid. And you'll see here, there's a lag here. So we're seeing a patient, we're incurring our costs and treating that patient on day 1 when we see them, but we're not getting reimbursed from the insurance until day 63. And that's very common. And so we have to be able to float those days and be able to pay for our bills. On the wages side, we're gonna have to pay for our payroll for our physicians to work, as well as the services and things that we need in performing our duties. So that's where we're paying those out, usually well before that 63-day mark. The importance of working capital, it's basically what makes our assets productive. It's what we use to pay our bills. And so we need cash to be able to pay our bills. Sources, where do we get that cash from? We're going to get it from our bottom line equity, where we've done services in the past and we have a bottom line available to it, that net income. We're going to possibly borrow money. So we might increase our non-current liabilities. We might do a small revolving loan. We might do a revolving loan to be able to make our payroll and things like that. So we might borrow that money, or we could sell some of our assets. We might sell some equipment or sell a building that we're not using. Okay, so other sources of working capital. If you're a government organization, taxes and bonds are going to be a source of cash for you. While nonprofits, besides the cash from the accounts receivable and the activities there, there is opportunities from fundraising. So, fundraising opportunities, people will donate funds, and you might also have tax exempt bonds. You would take a tax exempt bond and get funding through a tax exempt bond, which saves some money, or it could be government funding and grants that have some opportunity there. If you are a commercial for profit organization, there might be some sale of stock, and that would get you some upfront cash and working capital. So when healthcare organizations have an unexpected increase that depletes their working capital, and they need to increase it, this can come from equity, this can come from debt, trade credit. And the most common I would say here is more like a trade credit, a revolving loan. With a bank, typically your bank, you might have a 3% interest loan that you can dip into at any time and pay some of your payroll and things like that to meet your temporary needs. That's always really helpful to meet those needs, is to have that revolving loan. In managing your cash, you want to consider that conversion cycle. How quickly can you turn your revenue that you're serving that client? Now you have an accounts receivable. How quick can you turn that around and make that into cash? And so that becomes important, that revenue cycle. In healthcare organization, healthcare outflows, the biggest one is going to be wages. Paying for those providers is huge, but also supply expenses, where the inflows is typically your patient revenues, and that's where we need to turn that revenue quick. So how do we evaluate? How good are we? How well do we do? One of the ways that we can do that is looking at a current ratio, and that is current assets over current liabilities. That tells us basically, can we pay our current liabilities, and if so, how many times? So we should have more in our current assets than in our liabilities. We should be able to pay them more than once, and that would be a healthy organization. We can also look at days cash on hand. This is the calculation for that. And you would have your cash and your marketable securities over those total expenses minus depreciation, because you don't pay out depreciation. So what are those things that you actually pay out on your expenses over those 365 days? Additionally, here is another way to look at that in the days cash on hand and how long an organization can meet its obligations. Here we have cash, marketable securities, and long-term investments. And then again, we have that over total expenses minus depreciation with the 365 days. And here is an average payment period calculation. And this is the average time before that liability is paid. So if we take our current liabilities, and that would be our current accounts payable, as well as our current wages payable, and then we divide those over our total expenses minus depreciation. So what are those portions, so that we can look at what are those payment periods. And lastly, just talking about briefly a cash budget. So we can establish a cash budget so that we know we have enough cash. How do we know if we have enough cash? Those ratios are key to that. But we can also establish a budget for cash every year and look at our specific, when do we expect our revenue to come in? When do we expect it to flow out? And so we can prepare a list of all our expected sources of cash coming in and the amounts from each source, and then our outflows of cash and the amount that we have to pay, wages and accounts payable, and then look at what that ending balance is. And so, and to determine based on that, where are we going to be short? When are we going to be short? When in those cycles are we going to be short? And how are we going to handle that? The other side of it is we could be over. We may have too much cash. And in that case, we want to not just sit on our cash, but we want to earn interest for it. So we want to invest those surplus balances. Another thing to think about with cash, as we close this section, would be looking at whether you pay on terms. Like invoice terms gives you 30 days. So if you're paying your vendors in 30 days, you may be able to delay it out a little bit. And we'll talk about this more in our next section as well on cash. But if we pay for things on a credit card, it may be paid quicker, but we might get cash back. So often on credit cards for organizations, you can negotiate to get a cash back on your card. I get about 1.5%, up to 2% on my cards. And so when people purchase on that card, I'm getting cash back as a form of an extra funding. So those are the kind of things as well you can look at in your source and use of your cash. That's it for this overview section.